Personally, I don't think gold is a bubble. Gold is going to reflect a bit of greed, of course, when it really, when there is a real gold rush. I mean, anyone who had gold or silver during the Weimar hyperinflation and kept that gold throughout, they became well off. They didn't lose everything. It was the people that had paper that lost everything. So that's where I think we are. I don't think it's a bubble, and I don't think gold is dangerous at all. There's more danger staying in the fiat currencies of the world.
Gold has been on a remarkable upward trajectory, with its price surging by over 40% in the past year. It broke above $3,500 per troy ounce in late April, setting a new record even when adjusted for inflation, surpassing the previous peak in January 1980. At that time, gold's price stood at $850 per ounce. Economists have pointed to several factors behind this surge, with the unpredictability of U.S. trade policy, particularly under the Trump administration, being a key driver. These policy shifts have unsettled markets, while gold has gained appeal as a stable investment. Geopolitical uncertainty has only added to its attractiveness. Many investors now view gold as a reliable store of value, something once dismissed by billionaire Warren Buffett, who called it lifeless and neither of much use nor procreative. According to Louise Street, senior markets analyst at the World Gold Council, the current conditions create what she describes as a perfect storm for gold. Central banks, in particular, have been major buyers of gold, collectively purchasing more than 1,000 tons annually since 2022, a significant increase from the average of 481 tons per year between 2010 and 2021. Countries like Poland, Turkey, India, Azerbaijan, and China have been among the leading buyers. However, while gold is often considered a stable asset, it is not immune to fluctuations. Historically, sharp increases in gold prices have usually been followed by notable declines. Mario Innecco believes that gold is not in a bubble. Instead, he views its rise as a reflection of greed, but not in the conventional sense. He emphasizes that the devaluation of currency is a necessary reset, as the wealth created by unsustainable debts must eventually be recalibrated. This recalibration impacts all currency holders, regardless of whether they hold debt. Gold, which is inversely related to currency, rises in response to this devaluation, helping to alleviate the burden of indebtedness and pushing up commodity prices. Join us as we dive into the video for a deeper look. Don't forget to subscribe and click the bell icon to stay informed about our latest updates.
Personally, I don't think gold is a bubble. Gold is going to reflect a bit of greed, of course, when it really, when there is a real gold rush, because the public is not involved. That's what the BBC article doesn't really say. The public is not really involved. It's going to reflect more than greed though. It's going to reflect fear. And fear, why fear? Well, fear of currency collapse. I mean, anyone who had gold or silver during the Weimar hyperinflation and kept that gold throughout, they became well off. They didn't lose everything. It was the people that had paper that lost everything. So that's where I think we are. So let's go through how gold is a revealer of falsely stated wealth. And that's the everything bubble, the falsely stated wealth. When wealth is overstated and expectations for future wealth are unrealistic, fiat currencies depreciate. That depreciation is borne by the citizenry, who are forced to lower their living standards to compensate for both personal economic mismanagement as well as the mismanagement of the affairs of state. Financial and military overextension has a social corollary in overpromised Social Security, Medicare, overstated real estate, equities, affluence. As expense runs out of control, guarantees to the citizenry also explode as politicians that was taken for granted suddenly appears ephemeral. The amount of currency which once bought certain things no longer does, but wages have not risen along with prices. Well, that's what's happening everywhere around the world, to be honest. Instead of wealth, citizens, well, except for the top 1%, maybe even the top 10%, they're still doing well because they have a lot of assets. Instead of wealth, citizens get saddled with a big chunk of government debt, i.e. debt created by mismanagement, and it's not improving. I spoke recently about budget deficits still running really high, 6 to 7% in the US. Yes, in the US. The result is everyone pays more for food, fuel, and other necessities. Well, why is that? Well, because the currency becomes worth less and less because they issue more and more to cover those deficits out of thin air. And that's why having gold is so important. Government passes on the mismanagement of economic affairs to its citizens by devaluation. Yeah, you were that's what you're good for, unfortunately. I don't like to be rude, but we are, we're just sheep being driven to the devaluation pen. That's what we are. Unless, of course, you refuse to be taken to that pen and you acquire gold and silver. Dollar cost average, I would say. As the imprisoned money manager Martin Armstrong has artfully stated, and I quote him, the decline in the value of a currency is in reality a free market tax, taking away wealth that is overstated. So currency can also be an indirect tax to compensate for the poor management of state, end quote. The corresponding rise in gold, especially when it is a global phenomenon, as it is now, is in effect a devaluation of all the world's currencies and a restatement of wealth on a global scale. So there you go, BBC. Yes, balanced article, but I don't think it's a bubble and I don't think gold is dangerous at all. There's more danger staying in the fiat currencies of the world. As is both presently and historically evident, the attempt to restate wealth to a lower level becomes a competitive event in its own right as nations fight to devalue their currencies against each other to reduce the burden of indebtedness. It should be recalled that when FDR lowered the value of the dollar vis-a-vis gold in 1933, America was the 9th nation to do so in a 3-year period. Falsely stated and assumed wealth, largely created out of the assumption of debts that cannot be borne, must eventually reset at a lower level. Populations, yes, you, bear the restatement of wealth through the expansion of monetary aggregates, causing a devaluing of the national currency that denominates their wealth. This happened to all currency holders, regardless if they personally assumed any debt. Gold rises because gold is a monetary proxy inversely related to a nation's currency. The burden of indebtedness is reduced along with the standard of living. Commodity prices increase. Debt deflation has become currency inflation. They are one. So there you go. That's how I feel about gold being in a bubble. And I don't think you should be worried about the price, where it's going to go. It's going to go a lot higher, of course, in my opinion, mainly because governments around the world are not going to get religion. Politicians are not going to get religion and cut spending massively and cut taxes and cut the size of government and stop interfering as well. There's a lot of interference. There's a lot of talk of sovereign wealth funds in the States, things that really governments shouldn't be involved. But everywhere around the world, the governments and politicians continue to interfere. So that's where my money is. More continued mismanagement, financial, fiscal, monetary affairs. And that's why I don't think gold is anywhere near a bubble. What it will do, it will reflect the falsely stated wealth that we've seen evolving for the last 40 years. I mean, 40 years ago, you didn't hear of too many billionaires. You didn't hear the word trillion as it pertains to the dollar. So that's where we are.
The big question is, what lies ahead for gold? Some experts believe the upward trend will continue, driven by unpredictable U.S. policies, inflationary pressures, and central bank buying. Goldman Sachs, for example, has projected that gold could reach $3,700 by the end of 2025 and $4,000 by mid-2026. However, they also suggest that in the event of a U.S. recession or an escalation in the trade war, gold could even surge to $4,500 later this year. Given that the U.S. stock market is 200 times larger than the gold market, even a modest capital shift from the stock or bond markets could result in a significant percentage increase in the much smaller gold market. This means that even a minor disruption in major investment markets could trigger a substantial rise in gold prices. Mario Innecco believes that gold's stock-to-flow ratio, spanning over 60 years, illustrates that gold is less affected by supply increases than other commodities. He further argues that the rise in gold prices reflects growing fears about the collapse of the everything bubble. Now, let's redirect our attention to a video.
I will counter that by saying that gold stock-to-flow ratio is like over 60 years. What does that mean? Well, that means that there's more than 60 years of gold production around in supply. Even though gold is a very rare precious metal, it's the most abundant one. It's the most abundant commodity out there because all the supply that's ever been mined, most of it, 99%, is above ground. Of course, a lot has been lost through shipwrecks and other things. People have buried it and no one's found it yet. So the stock-to-flow ratio means that the price of gold is not very heavily, well, it's not affected at all by an increase in supply. Very negligibly. It's not like other commodities. And that's why it's money. That's why it's so stable. Yes, back during the gold rush in California, 1849, the 49ers, there was an abundance of gold in California and it drove prices higher in California, but it was more of a localized affair. It didn't really affect the world price for gold because of that. And the other thing I would counter Mr. Mills with is that there hasn't been a big gold discovery for over 20 years, and the mining sector has been moribund for the last 10 years or more. And there's been a very little capital put into the sector in order to find new discoveries, to develop new properties. So I think it would take more than just a few years to get the supply growing. And notwithstanding the fact that it wouldn't really have much of an impact on the price of gold. Gold, in my opinion, is reflecting fear in the everything bubble, that the everything bubble is going to burst. So what is the everything bubble? Well, it's the bubble that Mr. Mills, I don't know how old he is, but I would say the majority of investment managers, people who work in finance, they've never seen a bear market in stocks or a bear market in bonds. I didn't either. I mean, I started in the late 80s, early 90s, so I didn't really experience much of a bear market in stocks nor bonds. Yes, the bond market was still under the watchful eye of the bond vigilantes when I started out. But looking back at the long-term yield, let's say of the 10-year treasury, you can see that we've been in an everything bubble since 1981. And the mantra and the strategy from the financial sector, from Wall Street, from people like John Mills, is that you have to keep buying stocks. It doesn't matter if they crash or correct, you buy the dip. And it has worked for like 40 years, but I think that's changing. And why is that? Well, because if you look at the chart of the 10-year yield, that yield's starting to go up. It started going up in about 4 years ago in 2020, and we've broken the trend line that you see here from 1981. And the bond market is the most important financial market out there. It determines where stocks are going to go. And the reason stocks have been in an everything bubble is that bond yields have been, well, up until 2020, had been going down. We'd had lower highs, lower lows, and what that did, it allowed everyone, including the government, corporations, individuals, financial institutions, to roll over their borrowings at an ever cheaper cost. And what that did as well, it injected liquidity into the system, more liquidity, higher prices, hence the everything bubble. But I was thinking about talking of the bond market today because it's actually flashing some warning signs. And one market that you need to keep an eye on is the Japanese government bond market. And I think that's also flashing big warning signs. I think we could have a summer of chaotic market activity, mainly because bond yields are starting to rise again, not just in Japan, but here in the UK as well. As you can see, we're well above really the levels, just above the levels that we saw in 2022 when we had a crisis. US Treasury yields are not really playing ball. We're approaching 4.5 in the 10-year. The next key level that's important is 480. And what's that got to do with gold? Well, this is where I bring in Mr. Sinclair's, the late Jim Sinclair's book, A Pocket Book of Gold, a survival manual for monetary mayhem. And I think we're right in the middle of monetary mayhem, to be honest. And all the stuff we see, trying to survive this mayhem because they know it's coming, so they're trying to put deals together. And what they tell us in public is probably just for public consumption. What you need to know is that the system is in trouble.
With its inherent rarity, gold has been regarded as a store of value for centuries. The global supply is finite, with approximately 216,265 tons ever mined, according to the World Gold Council, and the total amount increasing by around 3,500 tons annually. As a result, gold is often viewed as a haven asset that maintains its value over time. However, as an investment, it comes with both pros and cons. Unlike stocks, gold does not pay dividends. Unlike bonds, it does not offer a steady or predictable income stream. How do you balance the role of gold with other investments like stocks or bonds in your strategy? Join the conversation, share your thoughts in the comments, give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.